All right, folks. Hey, this is Joe here, going out of my comfort zone and skill set here, looking, trying to record my screen. Hey, one of the questions that came in from you, the viewer, is can you compare a historical, make a historical comparison from 2000 to 2022, and that's kind of has some ugly periods in the beginning and then some good stock runs in the last 10 years. A 75-25 rebalance. Just start with 75% stocks, 25% bonds, rebalance annually. Start with $2 million. How does that work out? Compare that to what I often talk about is my 3-bucket portfolio, where I have 4 years of expenses in bucket 1, 4 years in bucket 2, and the balance in bucket 3. So can you make a direct comparison of that? So that's what we're going to do today. And so this may be pretty small for you, but make the best of it. It was kind of a complex analysis. So why did I pick 75-25? Why not 60-40? Well, what I was looking for was a very similar years that are in bonds. So safe investments. I wanted that to be very similar to what I had over here in the 3 buckets. So 5.6 years versus 6.3. That was as close as I got. Just trust me on that. So 75% stocks. This is pretty aggressive. Okay. So we're going to start with year 2000, which had a -9 at the beginning, then a -12, -22. Not a good way to start your retirement, right? So it kind of had an ugly start, but we started with 2 million and then just rebalanced all the way down through here. Okay. Ending balance after the end of 2022 was 965,000, which is about half what we started with, 2 million. And then kind of looked at the years that we had in safe investments. We got a lot of ones here, 1.7s, 1.4s, 1.3s. It was kind of an ugly time to, be investing. So that's a great comparison. How do these plans do when things are bad? Okay, so let's go over here and look at the 3 buckets. Again, started with 2 million. 80,000 was our withdrawal. Same for both. Index that for inflation, 2% a year. It's just what we did. That's what I did. Okay. A lot of other options. Could have left at 80,000 fixed all through that. Could have done some guardrails. I went with the easier button. Okay. So $80,000 removed each year. Now with buckets, each year you have to decide where you're pulling the 80,000 from. Okay. So that's a decision. It's not, a stressful decision, but you have to look at your bucket performance. If the market was down, typically I'd pull it from, bucket 1 right here. So after the first year, pulled it out of bucket 1. Okay. I pulled those expenses S8. Yeah, S8 come out of bucket 1. And so every year you have that decision, and then you have a decision of whether you want to rebalance. Okay. So I chose to rebalance when stocks were doing pretty well here in these 3 years. I was looking at it year by year. What decision would I make? I knew the future. So yeah, that may have influenced me a little bit, but I tried not to have it. So I rebalanced like when the stocks were doing really well in bucket 3, and I only had 0.4 years in fixed assets. I chose to rebalance and move like $100,000 into bucket 1. You could see it coming in here and coming in here for those 3-year periods. Just beefed them up. So anyway, taking a look at this one, what's ugly is the number of years really pretty low. 0.4, 0.4, 0.4, 3 years in a row that we had just half a year's worth of money in fixed assets. What's interesting is these 2 approaches had the exact same average number of years in fact fixed assets over that 22-year time period or so. Anyway, so exactly the same. The low water mark was 2008, 929. But it ended up with 1.211. So not bad at all. You take a look at a head-to-head comparison of 2008 and 2022. The rebalance in 2008 had 982. The buckets had 929, difference of 53,000, or 5% advantage to doing the rebalance. Okay, which makes sense. Rebalance is the safer, less in stock. Okay, but then when you get on to 2022, you had a $245,000 advantage to going with buckets, which was a 25% improvement. So year by year, which one won. So the three buckets, if this is in black, the three buckets had a higher total value. If it's red, the rebalance had a total value. So you can see a lot of red up here in the top. Makes sense. 2000, 2009, things were just ugly. But then, boy, what a strong finish here with the heavier stock portfolio in the three buckets that we were doing. So kind of a real strain to both systems. I mean, both of these are supposed to have a lot of money in fixed assets, and they didn't. Both of them did bad. I would say the one that I was trying to manipulate the most intervention, the three buckets, really did the worst. It had this period over here with just a half year. And that had to be some rough times with a system that's designed not to have rough times. So that was a little sobering. So what are my conclusions? Okay. Conclusions: buckets are more work. You must balance based on some fuzzy rules. When to balance, when not to balance. When you don't know the end of the story, it's hard to make changes halfway through. Rebalancing is pretty darn simple, less work, and you just kind of do it. Okay. Buckets give you the feeling of more control, but there can be a danger of overreacting. 2000 to 2010 was a horrible time. I mean, both approaches were, not doing well. 2010, 2022, that 13-year period was great for stocks, and that's the whole difference. It's pretty sizable, that 25%. Guardrails, most likely, if you had a 25% reduction in the stock market, folks, you're not going to spend the whole $80,000 adjusted for inflation. You're going to kind of dial that back. That's human nature. You may shave 10% off that or so. But it really comes down to the choice is yours. I'm impressed with just the simple rebalancing. You're buying, you're selling when something has done well, and you're buying when something has done poorly. That's simple. Doing that every year competed extremely well when, in challenging market times. Now, when the stock market is doing really good, it fell behind. And that's evident in this chart right here, 25% advantage. That's a lot of money, folks. But it took a lot of work, and there's a lot of intervention, and could be a lot of mistakes along the way. So that's my analysis. The choice is yours. I actually, I've been a 100% gung-ho bucket person until I did this analysis, which I've been stern on this for a couple of days now. And it really makes a great case for going just rebalance, just the easy button. And it's the conservative way to go, especially in retirement. I doubt if I'm going to change off buckets, but maybe I can add some rebalance in there and kind of blend it together. But I got to be careful not to fool myself into, turning all the knobs of my retirement portfolio, thinking I'm making a difference, and I'm just overreacting and making the system worse. So anyway, that's my analysis. If, I guess kind of high level, if you believe the stock market is going to have good returns, good solid returns and normal history, buckets are the better play. If you think you're going to have some tough times, some bad years, rebalancing is the better play. So it all depends on your outlook. Okay. So I'm sorry I don't have a better answer to that, but that's, there's always trade-offs. There's trade-offs to, if you want the potential for that 25% higher return, you're going to have a little more drama along the way. And do you want that? That's a question for you. No right answer. It's a question for you. This is Joe out.